Hey guys, welcome to today's video, and today's video topic about whether you should raise money or not raise money to start your business is one that I've personally been researching over the past few months and even year, because my co-founder and I on our real estate tech startup, Relia, have not raised any money to date, and we've bootstrapped, which I'll get into a little bit later in the video, but this is a huge decision that can affect almost everything about the business, from the current operations to what your life as a founder looks like, all the way to how the business grows in the future. And there's pros and cons to every situation in regards to raising money, but today I'm going to be going over the research that I have found and how I'm making our decision on whether we should raise money, who we should raise it from, and what we should use it to do. But first, it would really help if you guys subscribed and liked this video. I put a lot of research into these videos, and you guys can check out some of my other ones, but it would really help me if you guys liked and subscribed. I love doing research about these business topics, and feel free to comment on any business topic you'd like me to research and give my opinion about in the future. All right, so let's get started. The first thing that I wanted to talk about with you guys is bootstrapping, what it is and what the benefits are over raising money. Now, bootstrapping is the opposite of raising money. It's what I've done with our company so far and my previous companies as well. I've never raised money. I've always either invested myself or started out with basically nothing and just worked for free until I could get somebody to pay for me as a first customer and grow from there, reinvesting the profits from every single payment back into the business. Now, the technical definition of bootstrapping is the process of starting and growing a business using your own personal finances, revenue from the business, and resources. There are many success stories of successful businesses that have founders that decided to bootstrap the company, and bootstrapping really does give you some very strong strategic benefits. What are those benefits? Let me break them down for you. The first benefit that I want to touch on is all about control, and this is the benefit that I probably like the most out of bootstrapping and what I enjoy on a day-to-day basis. And control is really about, like, you have complete autonomy over what the business does, what route you take, what advertising platform you try, and everything comes down to you and you make the decision. And there is a lot of benefits with this, because if you have an epiphany or a crazy dream that tells you how to make $1 billion tomorrow, you can pivot the company on a moment's notice, have a meeting with all your employees, and change the direction right then and there. The alternative is, if you don't have a bootstrap business, you do lose that control and you have to consult with your partners or with your investors to see what they think about the decision that you're about to make. The second benefit to bootstrapping is going to be all about ownership. And with bootstrapping, you're going to own 100% of the business, or you and your partner own a collective 100% of the business. This allows you to really benefit from all the hard work that you guys do. If you get acquired, 100% of those proceeds go into your guys' pockets, as well as any profits that you guys have. You guys get to decide what to do with those. I've had businesses where we take profits every single month, and I have other businesses where we reinvested the profits every single month. But it's your decision. If you want to give yourself that big $100,000 a year salary, it's your decision. You own 100% of the company. You get to decide where the money goes. And when the business is getting sold, at the end of it, you get to keep 100% of the money that comes in. This is really nice because if you have a big purchase coming up, you can actually pay a distribution to yourself with the company's profits, and nobody can tell you otherwise. It's your money, you made it, it's your company, and you have complete control and ownership over the financials. And the final benefit I wanted to touch on that I really enjoy is the customer focus around bootstrap businesses. Bootstrap businesses tend to cater to and prioritize the wants and needs and feedback of their customers more than businesses that have funding or investors. And in my opinion, this leads to a stronger, more loyal customer base than if you're not paying attention to what your customers are saying. And I honestly believe that this is due to, if you're bootstrapped, you're usually on the ground. The company might be smaller, but it might not be. But the main thing is you have nobody to please but your customers. People that have raised funding and have investors, I often hear them worrying about what their investor is going to think about the money that's coming in or the feature that they're going to release more so than what the actual customers care about. And this is something that even if I were to raise money, I would try to instill in our company regardless. But the fact is, if there's other people's money at stake, they want to have a say and they want to be heard. So you're going to have to please them in some way, shape, or form. And in some cases, that does mean trading off what might be best for your customers to be what's best for your investors. But overall, I really love having a bootstrapped company. I feel like it's just a lot less stress. I don't have this weight on my shoulders worrying about what my investors are going to think or what they would rather have me do, rather than what I think that the company should do because I'm in the company every day. But now I wanted to get into funding and what are the benefits around funding. Funding is when you're seeking or that you have taken external capital in the form of money or resources from external investors. Now, this can look like anything from venture capitalists to angel investors to crowdfunding platforms, even family investing in your business, or anything where you accept monetary resources from an outside party outside of your original founders or yourself. Now, there are some very, very compelling benefits to raising money, and ones that I've been considering more and more each day as I grow our company. The first one, and the one that's been the most enticing to me, is just the potential for faster growth. When you accept external funding and you get an injection of hundreds of thousands of dollars into the business, you can immediately hire more staff, grow your team, spend more on advertising, and seize market opportunities and even outpace some of your competitors in a lot of different ways. And this is one thing that I've really been considering because as a bootstrapped startup, you're reinvesting a portion of the profits every single month, and the profits only grow a certain percent every month. So your growth is really, really, really gradual, right? But if you were to accept hundreds of thousands of dollars in 1 month, you can plug that $100,000 ad spend next month, and your growth would ideally hockey stick from there, and you would be able to roll that through and become profitable on that money. The second benefit is all about experience and connections. Now, if I were to go raise money for our company, I am not just going out to collect money and checks from different investors. I really want to raise from somebody that gives us a strategic advantage from being partnered with them. For example, raising money from somebody that has grown and exited a startup company in the past that has to do with a reoccurring billing model software. They would have a ton of insights on the growth, how to acquire customers better, how to retain customers better, and overall how to structure the company as we grow. There's a lot of mistakes that entrepreneurs make throughout their journey, and we make mistakes just like every other entrepreneur, but we have to make the mistake and learn from it rather than just having someone tell us that they made that mistake in the past and here's how to avoid it. The other reason that I would raise money from a strategic partner is just the sheer connections. I have a buddy that raised money from an investor that immediately got him into multiple sales meetings where the sales meetings were so easy because they trusted that person that invested in the business that he just showed up, pitched his business, and they asked, how much does it cost? Now, that is some kind of strategic move that you can make while raising money that can really take the business to the next level. If we got into a situation where the investor that we raised money from plugged us into 5 companies that were all enterprise level companies, it would really change our lives. So the benefit to that is really exponential, and it's something that is really hard to ignore when thinking about raising money or not. The next benefit I wanted to talk about is about enhanced credibility. Touching on my last point, raising money from an investor that has established credibility in a certain marketplace can really help your business convert. If you have a startup that nobody has heard the name of before and you're trying to sign a multi-million-dollar deal, it's likely the case that your customer might be a little bit skeptical of you and whether you can actually deliver on what you're promising. But raising money from somebody that has an established reputation in a certain industry can really change the game for you. If you even look at Shark Tank, my favorite show, raising money from any of those sharks can automatically get you into stores like Bed Bath & Beyond or Home Depot or even Walmart. And it's all about raising money from the right people. And on the show, you even see them cut companies' valuations for the value that they're gonna bring. They'll give them a lot less money for a bigger percentage of ownership just because they have that enhanced credibility and they're going to be able to get them into the distribution channels that are really going to change the game for the company and the company's growth. And the last benefit on the funding side, before I get into how to decide which way to go, is really going to be about getting access to more resources. With more capital, you can invest in more employees, more research and development, more development hours, and you can even hire some of the top talent in your industry. Along with this, some investors even bring to the table their own marketing teams, their own sales teams, their own coaches, and all of these things really work in your favor when you're thinking about the odds of your company being extremely successful or not. Now, I've been really thinking deeply about the pros and cons to each of these scenarios, and I've come up with a matrix to help you guys decide whether raising is right or wrong for your business. There are a few factors that I've really dialed into, and I want to share them with you guys here. So the first one is going to be, what type of business are you actually working on? Some businesses, like software startups like ourselves, require a lot of upfront work and development to get their first customer. And this requires a lot of capital, which is why you see so many tech startups raising money throughout the years. This makes external funding for companies like that extremely appealing. And I'm lucky enough to have a technical co-founder, which means that my co-founder writes a lot of the code in-house, which means that our startup cost to get up and running was extremely minimal. So this is not a factor that I'm considering, but if you're going to start a tech startup or a software startup, it's something to consider why you should be thinking about raising money. On the other hand, if you're a company like a product or a service, you can usually get started without having to take upfront investments and kind of roll those profits into each other. You might need to take out loans for new inventory if you're a product-based company, but overall, you can kind of figure this out and you don't always have to give away a chunk of ownership to raise that money for inventory or purchase orders or anything like that. The next factor I want you to consider is going to be your growth strategy. If you're aiming for rapid growth, if you need to overtake a market quickly, if you're the first to market and you need to stay as the market leader quickly, if you have a lot of competition coming in, then funding is going to be likely the best option for you. However, if you prefer more of an organic growth and one that you can kind of roll with the punches and reinvest the profits over a period of time, then you don't likely need to raise money and you don't need to give a piece of your company's ownership away. For us, we're kind of like in a middle ground here. We're growing really fast even without the funding, but we know we could grow faster with it. We're not dissatisfied with the rate that we're growing at, but it is appealing to think, hey, we could be growing at a 10x rate from what we're growing right now. And because of that, I'm kind of in a middle grounds on whether I need to raise money for growth specifically or not. The next factor to consider is your risk tolerance. Raising money can be extremely risky. Bootstrapping is not very risky as you don't have other people's money in play and you don't have an obligation to repay those people in the end. However, you are risking your personal finances if you're investing a lot of your own money into this business. Funding is going to give up some control and some equity, but it could minimize the risk to your personal finances. This one for me is kind of a toss-up. I mean, we are already profitable at our startup, so risking our own finances to reinvest back into the business isn't a huge deal for us, but the thought of having other people's money in play, for me at least, I'm gonna feel very, very, very responsible to those investors to get their money back in a multiple. And I'm not sure if I wanna take that risk on. And also having a risk of maybe finding the wrong investor. A lot of people are talk in the investment space and they say that they can do this and they say they can do that. But when it comes down to it, who's actually going to perform for you as an investor for your business? And who's just going to pay you for a little piece of your company and hope they get a return at the end? For me, I would need to feel like they really have skin in the game and they're here as more than just a checkbook for us. They're here to strategically help us grow through their resources, their personal connections, and their guidance. And the last one comes down to personal preference. You really need to consider your values, the goals that you have for the business, and then your overall vision. Do you see yourself at the top floor of a high rise with 100+ employees next year and you need to get there extremely quickly to dominate the market? Or are you okay making this your full-time job and growing this business over 10 years to get a bigger payout at the end? Also, it comes down to, are you okay with having other people's hands in the pot and having to take their opinions into account whenever you want to make a decision in the business that's going to affect your top line revenue? This has pros and cons for me personally, because while I love the freedom that my business gives me right now and the growth that we're on and having that full ownership of, yes, I did that, I also have a lot of big goals for myself and the company that I know we would get there much faster if we have an investor on board that is a strategic player. Now, ultimately, the decision to either bootstrap or raise funding is going to come down to your personal preference. As you can tell by this video, I've taken this and I've broke it down into pros and cons as well as decision-making factors. And I'm still at a crossroads. We're exploring some conversations with some strategic investors now, but I'm not sold on one way or the other. I would be perfectly happy staying bootstrapped. I would be probably perfectly happy if we raised money as well. I don't want this to become like a grass is greener on the other side for me, where I'm just raising money because I'm hungry for that next step. I want it to be a smart strategic decision. Now, one last thing to keep in mind is that it is one thing to own 100% of a business, but it's another thing to own 50% of a massive business. So yes, while you might be giving up some of your ownership, some of your control, and some of your baby that you've built, if you've built a company over years, you may be giving up 50% now, but that 50% you retain is going to be worth 10x what you probably could have did on your own. And it would have taken you 10 times longer with 10 times more headaches to get there. So overall, this is a very important decision to make. It's not one that should be taken lightly. I hope that the way that I've broken this down helps you make a better decision, or even if you're thinking about starting a company, helps you decide what path to take in the beginning. My name is Zach Herber. I hope that you guys have gotten some value out of this video. I love doing this research because these are decisions that I'm facing on a daily basis right now. And if you guys like this video and the research that I put into it, go ahead and share it, like, subscribe, and let me know in the comments if there's any other topics you want me to dive deep into or relate back to our startup, Realia.me. I will see you guys in the next video. I hope you're having a great day. Thanks.